Hello everyone, welcome. This is MJ Crypto and Happy New Year. This happens to be my first video of the year. Been so busy offline, but I'm back on track with you guys right now. Now, I kept blowing accounts 2 years ago until I discovered this amazing setup that has been working. Now, you can use this for your ICT models, you can use this for your liquidity concept, SMC, whatever you want to call it. This strategy works 90% of the time, and you can develop it to become better, right? Now, the first things first, you want to agree that traders who lose money in the market do not trade continuations. They try to trade reversals, and that's where the problem kicks in. Now, as a trader, your first move shouldn't be catching reversals. No, that shouldn't be your first move. You should trade alongside the dominant trend. If the trend overall is bearish, you go down. If the trend overall is bullish, you go up. So basically, that is how most of the big money is being made in the trading industry. Now, right here on my screen, you can see this. You can see this amazing setup. For those of you who are just coming on board, you can see this, right? Now, I'm going to illustrate this. I'm going to give a schematic for this right here, right now. Now, it goes like this, right? Very simple. It goes like this, come down, go up, make a range, basically, and then you sell back to the what? Low of the range. Now, practically, this would be the range high, and this would now be the range low, practically. Now, this is the same setup that has given me leverage in the market over time. And I'm going to be explaining this, breaking it down for you in simple terms so that you understand every aspect of what this is. This is a money spinner, right? Now, can you see here where we have the high, the low, low, high, and then these head and shoulders forming here. Can you see this? Now, it's the same thing that happens here. Now, at the point where we get a fake out, this is a fake out. Let me illustrate this better. It's a fake out. At the point where we get this fake out, this is the point where retailers are buying the breakout. They're buying the breakout out of the range, right? But practically, it is not an actual breakout. It is a fake out. It is what? A fake out. It is not a real breakout. Now, why do we say it's a fake out? It's a fake out because if you see here, when price makes a move out of this range, it goes back again, back into the range with displacement, with visible displacement. Now, for those of you who don't know what a displacement is usually a fair value gap. Now, let's assume we have a candle like this. We have a wick, obviously, on top of it. Right? And then now have a big candle. Have a big candle. We also have a wick. Have a wick on top of that. And then the third candle is not overlapping. This is where it becomes very tricky. So pay attention, right? And the third candle is not what? Overlapping. It's not overlapping here. Just a minute, just hold on. I need to pass this information as quickly as possible. Now let's look at this, right? Let's look at this very, very clearly. Can you see the wick? Okay, can you see the wick of this first candle here? Price is supposed to fill up this gap, right? It's supposed to fill up this gap. This is called a fair value gap, meaning at this level, the volume coming down was exceedingly much, right? There was huge volume coming down, creating a gap, a displacement in price, meaning price was not filled here, meaning transactions obviously did not occur at this level. So it's a displacement. So at some point in time, price will definitely want to go back to fill up that particular gap, as the case may be, right? Now, on this strategy, yeah, when we see a fair value gap coming back into the range, as you can vividly see here, see a fair value gap coming back into this range, we just draw the gap. First candle, then last candle, yeah? Now, price went back. It filled up 100% of everything, right? Filled up 100% of everything. Now, price is returning back again to the support of this range. To the what? To the support of this range. Now, this happens every single time. Now, the reason why this happens is because of one major thing. I'm going to be sharing that in the next video, which is the part 2. All right, so stick around to the very end. Don't go nowhere. The part 2 is going to be lit. I'll explain in details why this happened. It's called a distribution. Okay, a distribution of price, meaning sellers are actively what? Willing to sell now. All right, they're actively what? Willing to sell. I'll see you in the next video.